Are you working harder and harder and earning less money? Is managing the business bank account a daily challenge? Do you wonder at the end of each year where all your profits are disappearing to? In this show, you'll discover how you can pull the right profit levers and earn more money in your business.
It's time to love your business with Love Your Business TV. Here's your host, Adrian Peck.
So there are three, what I call profit levers that exist in your business. And there are only three. There are three ways that you can increase the net profit in your business. Now I want you to imagine a large tank of water, which is your revenue, and you can pull these three levers, and by pulling these three levers in a certain way, you're going to end up with more money on your bottom line. So the first lever we're going to talk about is this yellow lever. It's about sales. So in order to increase your net profits, you need to increase sales revenue. Now that isn't just about doing sales at any cost. It's actually about just increasing your price of your sales. So in essence, you're just pushing up your price of your goods and services. Now, I know that you'll say, well, that's easier said than done, Adrian. My world is very competitive, and the last thing my customers will absorb is any price increases. But there are actually some small increases you can make in your business without having a massive impact for your customers. And the whole point about talking about these three levers isn't that it's about making vast differences. It's actually just about making small differences, and you'll see the effect on them. So this first lever is this yellow sales lever, and it's about increasing your net profit by just pulling that lever back a little bit, and by increasing your sales revenue without increasing any other costs. So the second lever is about increasing your net profit by decreasing your cost of goods sold. So where we pulled the yellow lever back, we're going to push the blue lever forward a bit, and we want to reduce the cost of goods sold. So these are any costs that are directly attributed to your sales. So these will be any products that you have to buy. Ideally, it's normally labor that's also attributed to those costs of goods as well. Now, I do know that in a lot of situations with small business accounts, what they tend to do, accountants tend for some reason, that's unknown to me, is they put all of the labor expense underneath your gross profit line, and they put it all into overhead. It's actually the incorrect way of doing it, but I'm sure they have their reasons for doing it. But actually, it's about all the costs that are directly attributed to the sale of goods. So it will be things like obviously the cost of buying your products, consumables. It will be any direct postage or sales commission that's paid, should already be in that kind of cost of goods sold part of it. So the third lever is the overhead lever. So these are all of your direct costs. So it's your buildings, your insurance, your cost of administration, marketing, sales, rent, rates, all those kind of direct attributed costs that you have in your business. Utilities is another one as well. So the way that you increase your net profits here is, again, you push that lever forward and you just decrease your overhead costs. So let me take you through an example about kind of how this works. So if we take this business here, and I apologize for the people that are listening to the podcast, but if you can just kind of bear with me, I'll try and explain it the best I can without the kind of visualization. But so we're going to have sales here. We're going to keep the numbers really simple. You've got sales here of £1,000. You've got cost of goods sold, which is £600. So it's £600 of the cost that are directly attributed to selling those £1,000 worth of products. And we've got overheads, so that's your heating, lighting, rent, rates, etc., £300. So your net profit in this example is £100. You've got £1,000 worth of sales, £600 in cost of goods sold, £300 in overhead, so that's a total of £900, and that leaves you £100. So what we're going to do now is we're going to pull our three levers. We're going to pull the sales lever backwards, and we want to increase that sales revenue by increasing our profits. By increasing the price. We're going to push the blue lever, the cost of goods sold. We're going to push that forward slightly, so we're going to decrease that cost. And we're also going to push the red lever, our overheads lever, forward slightly as well. So let's just change them by 10%. So we're going to put our prices up by 10%. So therefore you've got £1,000 now is £1,100. We're going to decrease your cost of goods sold by 10%. So £600 becomes £540. And we're going to decrease your overheads by 10%. So £300 becomes £270. So your net profit now is £290. So it's £290. £1,100 less £810 gives you £290. Now all we've done is change it by 10% on each one of those elements. So we've increased sales by 10%, we've decreased cost of goods sold by 10%, and we've increased overheads by 10%. So we've just made a 10% difference across those three levers. Now what you'll realise here for the observant, and it's probably easier to see once it's in front of you and visualised, is that what has happened is that 10% change hasn't resulted in a 10% change on your bottom line, on your net profit. What you've witnessed is what's called a multiplier effect, and it's a profit multiplier effect. So when we took our £1,000 less 600 less 300, we gave £100 profit, and that's 10%. We changed the situation by 10%, so we took it to £1,100. We reduced cost of goods by £60 and reduced our overheads by £30. We ended up making a £290 profit, which is actually 26.4%. So we've gone from 10% net profit to 26.4%. So the importance here is that you pull all three levers all at the same time. Now that may change or alter in terms of how much you can pull at each time. It might be that you can't do 10%, 10%, 10%, but you may be able to increase your sales margin by 5%. You may be able to reduce your cost of goods sold by 3%. You may be able to increase your overheads by 20 or 30%. It doesn't matter too much. The point is that you pull all three levers and you do all three pieces of work, because that's the important bit. You get this multiplier effect across all the bits. Don't just do one, you do all three. If I show you as well, if you had just increased your gross profit by 10%, so you just increase your sales cost, so exactly the same goods, but you increase that price by 10%, therefore you went from £1,000 worth of sales to £1,100. You'd increase your net profit by £200, by £100, sorry. Therefore, the net profit would be 18.2%. So you can see that by increasing each one of those three like we've done, we actually achieved, we increased it to 26.4%. Now, if you to ask me where would I get the most bangs for my bucks, the place I would always start from is actually from reducing your overheads, and I'll explain why that is through this process. So if you wanted to increase your overall net profit quickly and in a tough market as well, the best place to start is with reducing your overheads down, because your overheads sit across everything that you sell. Whether normally your overheads would stay fairly stable whilst your revenue may go up a bit, and it would still, and you'd have obviously your gross profit would stay same as well. That doesn't make any difference. So you could do £1,000 worth of sales. Your overhead is the same. You could do £800 worth of sales, and your overhead stays the same. So it's always best to start with that overheads figure. The other side of it as well is that because that overhead is static, and you'll get more bangs for your bucks, you'll get more return on it. So in this scenario, if we go through the kind of numbers we've been working on, which is 1,000, 600, and the £300 worth of overheads. On that basis, we're working on a 40% gross profit margin. Therefore, for every pound's worth of overhead that you save, that's the equivalent of £2.50's worth of sales increase. So let me just explain that again. If you saved £1 on overhead, that'd be the equivalent of you selling another £2.50's worth of sales. Okay, and that's at a 40%. So in this scenario here, where we went from the £30, we reduced overheads by £30, you would need to increase your sales revenue by 75%, because of course for every sales revenue you produce, there's some gross profit or gross costs that have to be associated with it. Therefore you don't get the true £1 worth of sales, will be £1 worth of net profit. There's a cost associated to that sale. And this is based on a 40% gross profit margin as well. Where it really increases from, so through this scenario, if we increased £1,000 worth of sales, so we had £1,000 worth of sales, we had a gross profit of £600, gross cost of £600. We reduced the overheads down by 10%, down to £270. We'd be leaving a 13% net profit. If we'd done the same on your overheads, if we had done the same on increasing your sales revenue by £75, we'd end up with a 12% net profit. So it just shows you that you have more bangs for bucks if you start in overheads than you do on sales. Now this is working on a 40% gross profit. Now that's pretty hard going for a lot of businesses. When you start getting down to kind of 25, 20, 15% gross profit, that's when it has even more increase as well. So if you take the scenario of 20%, you've got a 20% gross profit, you're actually working on 1/5. So you need to increase your sales by 5 times that amount to get the same £1 effect in your net profit. So it's just the lower that gross margin is, the higher the effect is on the change in sales revenue versus overheads. So I would always start with overheads, and that's where you need to start looking at where you can trim some of that stuff down. So your action from this and from this whole piece now is to look at how you can increase those sales. And I say you don't have to increase the sales prices by much. It's only a few percent that starts having that effect. And again, with cost of goods, start with decreasing that down a bit, so you're actually taking some costs away, and the same with overheads as well. So your action is to look at those 3 levers and look at what you can do. In the show notes, I will provide you a free cash flow forecasting tool. In that tool, there are some self-help pieces in there of where you can look to reduce your costs down and help you do that as an exercise that I'll take you through within that. And there's also a free cash review as well, self-check, that is an online tool that you can go through, and it will tell you how well that you are looking your cash as well. So please feel free to grab them from the show notes. As always, there's always the Better Never Stops website that's got loads and loads of free tools on it as well. And if you want a copy of my book, please reach out to me as well, How to Fall Back in Love with Your Business. I'm happy to let you have a copy of that. Just reach out to me. As always, you can catch up on all our previous shows across Apple and Spotify and Love Your Business TV. We're also available on YouTube and Facebook and Google Podcasts as well for those previous shows. And when you listen to one of our shows, when you listen or watch one of those shows, we use that positivity to go make an impact in the world, because my purpose is to inspire ambitious entrepreneurs like you to live extraordinary lives and make a meaningful impact in the world. So when you listen or watch one of our Love Your Business TV shows, we provide a day's worth of literacy or business training to entrepreneurs across Uganda. And so far this year, we have made a massive impact of over 800 days trainings that we've done through all of those great impacts. So please keep listening, keep watching. We'll carry on making that impact in the world together. As always, if you want to reach out to me, it's adrian.peck@peckuk.com or through my website, betterneverstops.global. Stay safe and have fun, and I look forward to seeing you soon. And remember, better never stops.
Love Your Business TV. Thank you. Join us next week and don't forget to subscribe.